Hi, it's Greg Goernert, Vice President and Senior Investment Advisor at Canaccord Genuity Wealth Management and Goernert Wealth Management. Now, welcome to the channel where we help you make sense of the world today. Now, if you like my content, like my videos, make sure you press the subscribe button. Now, I'm going to be joined today by Canaccord Genuity Precious Metals Analyst Carey MacRury to talk about the gold market and all things that glitter. Carey, how are you today?
I'm great. Yourself?
I'm doing well. Thanks for joining me. Now, want to walk it through because there's been a lot of talk in the market about inflation is suddenly rearing its ugly head. Not that that's a surprise. Why don't we talk about just the macro events for your world as far as the precious metals, the gold, the silvers, and everything else, and then maybe drill down a little bit more about maybe some currency moves, some volatility, and just where you see the market right now.
Sure. So maybe we just start looking back to last summer. Clearly, gold had a great run from the bottom of the COVID panic, I guess, of March or April 2020. And then we saw, gold go through 2000 by the summer, but, hit an all-time high, but then sort of petered out. And, it looked in retrospect like it might have been a bit overbought in that time frame. And obviously we've seen a bit of consolidation from that 2000 level through to sort of just under 1700 back in March. But, we're picking up steam here again, which is something that we expected. Just going back, if you think back to when gold started really getting weak, we had the announcement of the vaccines. There was the whole idea that, the world's going to normalize. So if I bought gold as a safe haven, I don't need gold. I'll just buy pretty much any equity or commodity has gone up in the last 6 to 9 months. So I think we worked through that part of the trade. Now, as you mentioned, inflation is starting to pick up, at least on a year-over-year basis. And that's starting to get more interest in gold. But, broadly speaking, the fundamentals for gold we think are still strong going forward here.
Yeah, no catalyst going forward. The spot yesterday, we closed up 260 at 1866, and silver was up 83 cents. Why don't we talk a little bit about seasonality? Because right now, there used to be the saying, sell in May and go away. And where do you see things on that side?
I think seasonality is a bit less impactful this year. Just, again, this is sort of unprecedented times. We're living through the recovery of a pandemic. But, if you think about the world, the US is, I think, through 50-60% of people vaccinated, largely opening up. And yet, look at the 10-year bond, it's at 1.6%, gold's at 1850. So what's going on? Well, I think what's going on is, again, if you think pre-pandemic, the Fed has sort of admitted that they've undershot on inflation for, since the global financial crisis. If you look at their target of 2%, they've hit that target 13 times out of 135 months. Yeah. So they know there's been something they've been undershooting. So they're committed to higher inflation going forward in this new average inflation targeting regime, which is going to allow the economy to run a bit hotter than normal and inflation to run hotter than normal. Versus, the end of the last financial crisis, they were sort of quick to tighten in 2013, quick to raise interest rates, and ultimately had to cut rates at 2%. So I think they've admitted that they've undershot, which is why, they're pretty adamant. You listen to Jay Powell, he's pretty consistently saying, we need to see actual inflation above 2% for a certain time before we're going to do anything, as opposed to, reacting on forecasts. So I think that macro view of higher than 2% for longer, the market, and you probably read the press. I mean, every day it seems to be an inflation story and people are worried about runaway inflation, but this story is going to be going on for the next at least 6 to 12 months in our view.
Yeah. I mean, they've been very, very clear about saying, they're going to let the economy run hotter for longer this time. And the other thing I think that people need to also remember too is that in the United States, the U.S. Fed has a dual mandate. They have employment mandate as well as an inflation target as well. So they've got to balance those two, going forward. So that allows them extra wiggle room to go a little bit hotter, a little bit longer here. I agree with you. I do get the sense that this time they're bound and determined to make sure that we get some inflation back in the mix and not to go back to undershooting as they have in the past. Why don't we talk a little bit, and we touched upon it there, but why don't we talk about sentiment in the space, and then maybe some of the names that you're following that are on your list.
Yeah, I think investor sentiment, I would say it's mixed. Again, I think there's a view that with normalization, everything's great again. Therefore, why do we need to own gold? I think that's still pretty widespread out there. But that being said, I mean, for those who are paying attention to things like debt, debt levels in the United States rose 20% last year, which is a huge increase. And when you think about that in context of GDP growth, we're at World War II level highs going forward, and then, Joe Biden rolled out new stimulus and there's an infrastructure package coming. So, when you think 2-3 years down the road, I mean, when the bills start to mount up, who's going to pay the bills? So gold tends to do well in a world of, zero or negative interest rates, which we think is sort of the base case for longer. And then rising debt levels just makes it even more challenging going forward. So we think gold's a pretty good asset here.
Yeah, now gold is obviously denominated in US dollars. What about currency risks as far as the commodity going forward? How do you see that playing out?
I mean, I think our default view is it's similar to sort of 2009, 2010, coming out of the financial crisis is not that dissimilar from what we're seeing today, where we're seeing, rising bond yields. But that being said, rising inflation expectations. So real rates have been sort of, they're still negative. We've seen every commodity price in the world rip. We've seen the Canadian dollar strengthen.
Yeah.
Pretty much every currency around the world has strengthened relative to the US dollar. So, that puts some pressure on producers that are, obviously producing outside the United States. Like Agnico would be a good example, where all their production is either in Canada, Finland, or Mexico, and they've seen appreciation of all those currencies. And then obviously you've got companies more like, Barrick or maybe Newmont, where they're a little bit more US centric, where they don't have that same currency exposure.
Yeah, now you bring up a couple of names there, and one thing I really like to juxtapose from a financial perspective where the gold miners are today versus where they were coming out of the financial crisis. Because as far as balance sheets are concerned, as far as acting like real companies, there seems to have been a change.
Yeah, no, that's a great question. And, I've talked to some investors who literally hadn't looked at the sector since, 2010, 2011. And, when you look at the sector today, it's really built on operating at 1,200 or 1,300. In the last cycle, a lot of companies made mistakes. They overbuilt, they overbought, they paid too much. There was a lot of write-downs. So management teams today are very conservative. Reserves have been done at $1,200 an ounce for the last 5 years, and that hasn't changed. So I think, again, discipline is here, whether it'll last, 2-3 years if we have healthy metal prices. But certainly, the industry has changed quite a bit today. And then to your point, balance sheets are in great shape. Most of our coverage universe is either in a net cash position or will be in a net cash position in the near term future. And, when you think about margins, I mean, all-in sustaining costs in 2011 were $1,200 an ounce. The gold price was $1,700. So companies were making about $500 an ounce. Today we've got $1,850 and costs are $1,000. So companies are making $850 an ounce. So and that's back to comparing to 2011 to the previous peak. So
exactly,
industry's in a lot better shape today.
Can we just
probably never been better?
Yeah, no, I know that too. But just to be clear for the viewers, can you walk in what all-in sustaining cost is? Because I know sometimes people get a little confused by that, or they maybe say it, think they understand, but don't totally understand it.
Yeah, I mean, the main focus there is, in the past, companies tended to focus on a cash cost number, which is really just the cost of, the operations. But, mining is a very capital intensive business. So, it's not just the operating cost. There's a lot of capital that's got to go back, either stripping big open pits or, doing all that underground development and underground mine. Then you've got your G&A cost, you've got exploration costs. So rather than focusing on a small, operating cost, which in the old days would have been something like $500 or $600 an ounce, and all-in sustaining cost is really the cost of keeping the mines running. Now that doesn't build new mines. You still need to invest money if you're going to build a new mine, but that's theoretically the cost of keeping your existing operations running. And today it averages about $1,000